Welcome to the Real Money Show, the number 18778 Silver, the website guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correa, and I'm very excited to talk today. Just excited to share our thoughts with our listeners this week. We're going to talk about debasement, de-dollarization, debanking, an interesting week in the markets. First, let's talk about what we saw. The gold and silver market came down this week. And, gold is down something like 1.5% over the last 6-7 days. Silver's off by about 3.5%. So gold came down from, mid 19 range down into the low 1900s. Silver was trading up around 23.5. We've come down to 22.70. But let's just remind everyone that gold is up 6% this year, or year over year, and silver's up just shy of 9% year over year. So I always like to keep the big picture.
You have to
when you're seeing pullbacks, and our audience is obviously well versed in pullbacks. They're used to the ride, and anyone who's held precious metals for the long term can be easily put these moves into perspective for the long term, because in the long term they don't matter. In some ways, though, I do find them curiously kind of narrative cover for the other things that are happening. It's like something bad is happening. Push the price of the metals down, because the people aren't selling per se in a big way that should be pushing the price down. It's paper. But on the other hand, we can see plenty of examples where people are buying en masse, like Poland this week, for instance. We'll get into some details on that.
Yeah, there's a lot of central bank buying continuing to support the ownership of physical precious metals, specifically gold, in times of immense debt, immense inflation continuing to rise. We're seeing a little bit of a dip, a bottoming, as we say here in the headline inflation data that came out this week. A slew of data. The CPI data came out yesterday. In fact, a little bit lower than expectations. So that sort of justifies maybe a pause in interest rate hikes going forward next month, but it's very short term. In the long haul, we have to stay focused at the big picture. And you're right, Jeremy. It's a total diversion away from the real stories that are at hand. The debt, the federal budget deficit surging to 1.6 trillion in the first 10 months. Fiscal deficits, fiscal policy, monetary policy, and even personal monetary policy. Just seeing that the average American is just underwater. Credit card debt in the U.S. has surged over $1 trillion. And this is very much indicative of the type of squeeze that the people are feeling. The banking situation is going through, and it has entered into and going through a series of hits. Moody's again cuts the credit ratings on 10 banks this week, places 4 of the 15 largest banks in the U.S. on review for possible downgrade, including lenders, Jeremy. So trying to decouple from counterparty risk is very important.
So I was listening to an interview with Jim Rickards this morning, actually, with Sarah Pomboy on Wealthion, I believe. We put it on our Twitter. It's on our Twitter, or X, whichever you prefer. And he was talking about that the U.S. dollar, with the BRICS, we've talked about the U.S. dollar being weaponized, that they blocked countries from getting their money, specifically Russia. And other countries looked at that and said, well, wait a minute, if you can do it to them, you can do it to us. And that's really what has sped up the BRICS process to get to a new currency. And we'll see how it all plays out. He had a very interesting take, Jerry. He said that, in effect, if you're refusing to pay out, the bond market is all about trust. And if you have just refused to pay out, forget weaponization, that's a default. That's how he put it. It's a default. So what if maybe these banks that are potentially being downgraded, is you've got some squeaky paper over here.
Something. I'm trying to figure out what it is.
What if these downgrades on these banks or people being censored from getting their funds out of their own personal banks, like Nigel Farage, which we wanted to talk about today, is a form of default?
That's right.
Right? Instead of a punishment, maybe it's put under the guise of punishment, but censorship being a euphemism for default.
That's right.
What do you think?
That's the way I see it.
Really?
It is, and you could just do a quick search on debanking, and Nigel Farage does come up. A number of our clients were affected by debanking as well. So this is nothing that is just happening in places in the UK. It's happening more so in places in the UK, even in Australia now we're seeing that. But this is a trend. So when we start seeing these negative defaults happening, if you're not going to be paying out, that's definitely a default, Jeremy. That's the way I see it.
So let's get back to the metals market at hand. We did get a pullback in the market. We always want to discuss and put it into perspective because you see the market pull back and you say, okay, what's changed? This isn't a significant pullback in any way, but what's changed in the world? And you look, you say, well, the debts are only increasing. The debasement's only getting worse. It's not getting better. Okay, they've been fighting inflation, gaslighting all of us that it's our fault, that the economy's too hot. It's our fault.
Slow down, guys.
Yeah, slow down
with the growth.
Yeah, don't go to work. You've been creating inflation. It couldn't possibly be us printing the money over here. But nonetheless, you say, okay, but it's already done. It's all been done. It's in the mail. They've printed. They've got the debts. They've got 32 trillion in debt. The debt to GDP is over 100%. It can't be beat. The currency will have to be debased. You can only tax people so much. There's only so much you can pull up your bootstraps and place the blame on the middle classes. It is going to be debasement. And so if the currency is destined for debasement, then you have to protect against that.
Oh, of course.
And if gold and silver went down, then that would be a great place to start. Get it cheap.
And we have to get into that, making the case for buying this dip, because if we dissect through the CPI, which is the consumer price indicator, the inflation indicator that came out this week, the government is telling us that inflation is 3%. But the goods and services we buy daily are on average 10% or higher. Like here's a following from Golden Coast Consultants: 17.8% on car insurance, 14% in tax services, 14% in food, 13% car repairs, 12% on fruits and veggies, 11% in bread. That doesn't look like 3% to us. Why are they telling us?
Or the fact that they raised interest rates and people with variable mortgages or have to renew are, they're up like 50%.
Exactly. So when we see that real world inflation is much higher than the narrative, people must take action for themselves, because we're supposed to trust these governments, right? And this is why we've talked about the growing distrust of governments have caused people to look away from the norm, from the typical conventional arrangements that you should be putting your money into. And if people could just understand the type of banking system that we have, Jeremy, with regards to Moody's first downgrading the credit last week, that was really a downgrade against the US dollar. First and foremost, because everything is denominated in a currency that has been debased. But they're telling us it's only been debased by 3%. No, if we go to goldprice.org and look at every single major currency going back from 2007, every major currency is being debased by an average of 9 to 10% per year. So we're in a rat race. We're in a race. We're losing time, because in 5 years, you have just lost 50% of your purchasing power. And what do? Do we continue to trust? Absolutely. I think trust is just down the tubes. This is why we love meeting people. Our doors have always been open, even through the lockdowns. We've loved to have people in. We've met freedom groups. I've been involved with some amazing groups, Jeremy, talking about how to barter with coins. I'm going to get into that probably maybe in another show, put together a presentation into September or October on how we citizens can use silver for trade and barter and trade. But distrust of governments. That's just one of the major tenets as to why Canadians or world citizens are moving away from the traditional banking system.
Definitely, gold is trust. Silver is trust, because there's a finite amount of that product. It takes blood, sweat, and tears to get it out of the ground. There's a cost to get it out of the ground. Once it's been refined, the energy is stored, and that's key. But the bigger key is that it's zero counterparty risk. That's why it's safe. That's why you can trust it, because you can't have someone print it out behind you, right? Mm-hmm. If you put cash and gold under the bed, the cash can still be printed into oblivion. It can still buy you less and less every year, whereas gold on the long term ends up always keeping up with inflation and surpassing it. So when we talk about price, we're talking about two things. It's not just the price, but it's what you can buy with your gold. It's people who have held gold or silver for a very long time, they tend to not think of it in terms of price per se. They think of it in terms of how many ounces do I have? Mm-hmm. How many ounces of gold do I have? Oh, okay, I've got this amount at $1,900 US or 2,600 Canadian, and here's what it's worth. It's a very easy calculation. It's like saying, how much cash do I have sitting around for a rainy day? Mm-hmm. And with gold, you start to realize that in 1980, gold hit $850 an ounce. The Dow fell to 850 points. That's a 1-to-1 ratio. So 1 ounce of gold would buy you the Dow. In 2011, we hit 4-to-1. 4 ounces of gold would buy the Dow. Today, we're at 18-to-1. So imagine that. Imagine if it came down to 10-to-1 or 6-to-1 or even back to 4-to-1. And imagine if the Dow, which is overvalued, if you think about all the PE ratios, if it were to come off by 15, 20, 30%, if there was a panic, that would probably only bring it down to like 27,000 points, 26,000 points. At a 1980 price to $1 trillion, that would put gold at around 27,000, which would be a 1-to-1 ratio on the Dow. Now, again, you don't have to see those. If you divided that by 4, like we did in 2011, or divide it by 10, you're still looking at $5,000 gold. And imagine where silver goes at a ratio of 30-to-1. Mm-hmm. Right now we're at 80-to-1. These ratios are telling us, they're begging us to acquire gold at these low prices because they're so cheap against these debt-laden indices, right? Debt-laden houses that are still in bubble territory, all of these things. Let's talk a little bit more about the ratios, about the value of the metal and where that is going to be, and how many ounces of gold you would need to buy a house, or how many ounces of silver you're going to need to buy a house in the coming years. The number 18778-SILVER, the website, guildhallwealth.com. It's all about physical gold, physical silver. Go to our e-store, guildhallpreciousmetals.com. More to come on The Real Money Show, 640 Toronto. Welcome back to The Real Money Show. The number 18778-SILVER and the website guildhallwealth.com. Jerry, if you were new to investing, new to the investing world, we're not advisors. Speak to your advisor, speak to those you trust. If you were new to the world and you were looking to build wealth and you're looking at the stock markets, are you sitting there thinking, oh, well, if the Dow, just using one, is trading at 35,000 points plus, and we're in a inflationary era where everything costs more, the businesses have lower margins. Look at UPS; they have to pay out $170,000 per employee now.
That's right.
So your employees are asking for more. Your margins are down because everything costs more to create or get to you because gas prices are high. All of these things, business margins are way down. Okay, and your general costs are way up. So is everybody going to run out and buy an iPhone this year? Are they buying 6 pairs of Nikes like they did a few years back? Probably not. So if you're an investor, you looking at the stock market, especially a new investor, saying, oh, well, it could easily double from here. Or do you start to look for things that are very inexpensive, like silver, which is trading at, $22.70
Mid-20s,
when the
right.
cost to bring it out of the ground is something like $17, and they've just banned open pit mining in one of the biggest areas of the world where we get our silver, Mexico. You can't even get it from the open pit.
You can't get it.
So where would you be going?
Exactly. When we realize that our cash is being squeezed and our savings are squeezed, you start to think, wait a minute, you're hitting my bank account here. You're hitting my livelihood. So you start digging and you start researching what is going on. How can the valuation of the stock market continue to rise as well as every other item? So is this just isolated to the stock market? Absolutely not. All asset prices are moving higher in tandem with everything else. Gold and silver, on the other hand, are being held back. We're using contracts. And when we're thinking of the simple diversification, negatively correlated assets, everything seems to be correlated. The correlations are being thrown off. In times of trust, you start looking at what the big money is doing, right? If you are a newer investor, what have the successful been doing? How have generational wealth builders built and preserved their wealth? There's many, countless families that have done it. And they've always included gold. And this is what is so special about physical gold being wealth insurance. You want to insure the wealth that you have, plus grow it at the same time. And we're going to get into that with regards to the German central bank, why they've been holding gold. And, it's a unique combination, Jeremy, of independence from all of the currency madness, all of the devaluation and debasement of our currencies, the financial institutions that could be shaky. These people who are newer investors, they may see some of the issues with the banks. And this is the reason why central banks hold a portion of their reserves in physical. They need independence from all of that financial madness, as I call it, and liquidity. Because at the end of the day, you want to make sure when I need to sell it, I'll be able to sell it for whatever currency I want. I'm not just isolated to the Canadian dollar, because I don't know if the Canadian dollar will be around in 5 years, 3 years perhaps. We don't know. Canada does not have an ounce of gold in its coffers. So us Canadians have to do the wise thing and become your own central bank. And that, to me, Jeremy, that just speaks volumes for any newer investor thinking. Why are the central banks holding gold? Why aren't they holding hoards of cash for the next 5-10 years? They don't.
Yeah.
You don't go into the central bank and see cash, paper.
None of them hold crypto either.
They don't hold that either,
except maybe Ecuador, and their biggest
El Salvador.
Was it El Salvador? Mm-hmm. Okay,
yeah.
Poland's central bank has bought 2.3 million ounces of gold so far this year alone, which, by the way, would calculate to about just under $4.4 billion worth of gold. Now, I do find it ironic that these central banks are buying gold and they get to just print the money to pay for it. Right?
That's right, I know.
We don't get to do that. But nonetheless, if they're doing it because they're hedging the fact that they understand the game better than anybody. They understand more than anybody that the emperor has no clothes, that this is a confidence game, and that confidence could be sucked out of the room at any moment, right? Then they would definitely want to protect themselves against that. So again, gold is trust, and you want to have those physical assets as part of a portfolio, especially when you're trying to battle the debasement of the currency. And the debasement of the currency has led to the debasement of culture, the debasement of values, and now it's leading to de-dollarization around the world. And now it's also leading to debanking, which is something we touched on in the last segment. But what is it that's kicked that off? We mentioned Nigel Farage, who once upon a time was a gold trader, by the way.
That's right.
He used to be on King World News interviews all the time, and then he entered into politics and kind of became a major player in politics as independent in a way. Also very very vocal about Brexit. Which, by the way, speaking of Brexit, in 2016 when Brexit happened, when they all agreed to do it, the pound dropped 30% against a basket of currencies, and gold went up 30% in British pounds.
That's right.
So if you already owned gold in England, nothing happened. You maintained your exact purchasing power you had. You could travel anywhere around the world. You had the exact same purchasing power. If you didn't, then everything that you did outside of that country was 30% more expensive. That includes all the imports into your country as well. That's just a perfect demonstration of how gold can hedge against a debasement. And in that case, it was a rapid debasement. It was an overnight debasement. If you look at countries like Turkey, Venezuela, Argentina, the list is growing now. Lebanon is another one where they've experienced hyperinflation. The price of gold can go to priceless, right?
Yeah, Argentina especially.
So let's talk about debanking.
Got to be ready for it. This is the definition of weaponization of the banking system, or money that is sitting on top of the SWIFT system. That SWIFT system is the digital system. The money sitting there in your bank is not paper cash, wads of cash sitting on a bank account in the vault. No, this is just inputs, ones and zeros on a communication board, and that's all it is. And if you become unpopular, or you decide to use your First Amendment right of free speech, and it's unpopular, well, you don't necessarily have to be a terrorist and bomb buildings and be this nuisance to society. You just have to disagree with the narrative and with the mainstream narratives, and that's what that was.
But do you think
Farage?
Okay, so they did that with the convoy in Canada. It looks like they want to go cashless in Australia, and they did it to Farage, who is highly visible. So they want to go after someone highly visible to make everyone else second guess. But is that something that's really going to happen again? I mean, when we talk about censoring people or cutting people off from bank accounts a year ago, 2 years ago, they pulled back on that within a week. It was almost as if the Prime Minister got a phone call from a major bigwig at a financial institution saying, "What are you doing? Do you understand how much money is being pulled out of these banks right now?" Like, for me personally, I don't think I'm as worried about censorship through debanking as it was an issue maybe a couple of years ago. Mm-hmm. I'd still be more worried about the debasement of the currency and being aware of the debasement of the currency, and not just fall into these back and forth in the wind arguments of whether or not raising interest rates is working, right?
That's true.
On the economy. Also, Jerry, on another note, newsflash coming from our friend Kevin Fernandez 82 at Instagram. I don't know if you heard about this.
Not for today.
It says, forget government issued digital currency, says Bank of Canada report. They conclude Canadians don't need it and don't want it. Acceptance could be challenging.
Mm-hmm. Yeah, I saw that. And I also saw this week the Bank of Canada released a survey, the results of a survey. They surveyed a bunch of merchants, and 96% of the merchants are want to avoid going cashless. They prefer cash in day-to-day banking or in day-to-day business. So
of course they do. When you're paying 40% income tax and
no tax.
And it's it's like the worst country to try to get ahead in business. Cash can be a good thing.
Cash is a good thing. Yes, we don't knock it.
No, it's a great thing. Look, and the other thing, we've talked about this on our show. I've seen this passed around through social media and whatnot. This idea that when you use cash, there's no additional costs. When you're using credit cards and you're using bank machines and all of these things, there's all these little tiny fees eating away, whether it's a penny a transaction or even if you were to roll it into the overall cost of the machine every month. The fact is that when you use $50 digitally and it passes through 20 people's hands, it's no longer $50 that's being passed around. It's now the fees to the financial system, to the banking system, has whittled away. They've taken it away.
But it's no big deal, right, Jerry? It's just normal transactional costs.
But it's still being sieved off the top to the financial system versus maintaining itself in the community. Mm-hmm. If we pass around a $50 bill in our community, right, go to the hairdresser, go buy some juice, pick up some groceries, and we're paying with cash. It's staying in their hands. A waiter, you're giving them a cash tip instead of them, having it through the credit card.
Right.
All of this is adding to the money stays and plays in the community, giving the community a bigger chance. Why inflation is an insidious,
it's everywhere.
Stealthy cancer on your wealth.
Yeah.
And this idea of the ease of credit cards, the ease of digitization, you forget the fact that there's a little cost for that. E-transfers, there's a little cost for that, right? You do a few e-transfers a month, guess what? They ding you with $150, with $1.50, $2, right? So just being conscious of, nothing is free in the world, and convenience costs money too. And you can always rationalize that. There's always different conveniences you can rationalize. Like if you're a family, you go, I'm going to Uber Eats because I'm just too tired to make dinner.
Right.
And that's a cost effect for me. Whatever. You get the point. You can always rationalize these things. But at a point, why not keep the money in the community?
Exactly. I mean, this is the beautiful thing, and this is the necessary thing about hard assets. And what is your hard asset? When the currency is being dwindled away, when the currency that is sitting in the bank is sitting in a fractional reserve bank. If people only can realize what a fractional reserve banking system is, and this is global. This is not just here or in where we usually see it, the major players being the New Zealand, the UK, Canada, US, and Australia. It usually happens in these countries, right? It's really not the BRICS alliance. If we understood what the fractional reserve banking system was, you would get your money out right now. And this is the urge. And I think we have to really look at how we're protecting our money. Are we going to go back to the same old, the stock, bond, cash approach, keep it in a GIC for the next year? Well, after a year, you're going to be even worse.
Well, let's talk about that in the next segment, because interest rates have gone up. You're getting more return for your money parking it somewhere. Is it going to be enough? The number, 1-877-8-SILVER, the website, guildhallwealth.com. More to come on The Real Money Show on 640 Toronto. Welcome back to The Real Money Show. The number, 1-877-8-SILVER, the website, guildhallwealth.com. At Guildhall, we only deal in physical precious metals. If you want to buy some physical precious metals, take home delivery, set up an appointment, come purchase that direct at Guildhall. We're more than happy to do that. We love anyone who's starting fresh, want to pick up a tube of silver maples, a 10-ounce bar. We've got a 50-ounce combo that you can see on our e-store, which is a great way to start. And the idea is you want to put some physical in your hand, because there's an aha moment that happens when you put that physical commodity in your hand. You just, the lights go out. This is real money. This is real money that I can make economic decisions over a 50-year span, because the value of this is going to be there in 50 years. So we love when people start small. We encourage people to start small. 10-ounce bar, an ounce of gold, start small. And then you can build up to, we do offer depository services if you're concerned about the storage of a large amount of product, and insurance for a large amount, and liquidity. Look, Jerry, you know it. I know it. Guys, a lot of people have been leaving Canada. A lot of people are really sick of the policies that they've been seeing about the distrust with the government and the way they feel that they're being treated as Canadians. And we've seen it in our business. We've seen multiple clients leave the country. I've had friends who are not involved in the gold market leave the country.
It's true.
Right? And, they say, okay, how do I do this for our clients? Look, they still hold it in their depository account. They've got that ease of liquidity should they need the funds, and they know it's fully insured.
Yeah.
So there's a lot of benefits to that. But the best place is the registered accounts.
Hands down.
Hands down. In a registered account, you talked about it, Jerry, in the second segment, about over a decade period, you have to make 50-60% to keep up with inflation. So you've deferred your income, put it into a registered account. Now you have to make sure that the money that you put into that account can buy you the same amount of goods in 10, 15, 20 years. And the longer you hold gold and silver, the more it does that for you. Gold's up 450+% in Canadian dollars. Silver's not much different over a 20-year period. And that destroys inflation. That not only helps you keep up with inflation, but that would allow you to pay the income tax when you withdraw it. Or if you even wanted to pay the penalty to withdraw it, 30%, you could pay that too. Like, that's what can happen when you make when gold does what it does. And it's always done it.
That's what it
does. But we
does.
just can't think myopically in terms of what it did for me today, what it did for me last week. You have to think in terms of a longer period, which is why we talk about 10, 15%, right? As a hedge.
That's right. That's the beginning. That's where we usually start at. Crawl, walk, and run. That is usually the mantra that we begin, but you'll realize how quickly you mention it's this aha moment of what gold and silver actually do. When you get that physical metal in your hand and that 50-ounce silver combo in your hand, that's going to spark something, and you're going to start looking into what money is not, what has survived for thousands of years. And it is that gold, it is that silver. And if you have money sitting in your RSP, locked in with, into some GIC that's literally just sinking. You're in a sinking boat because
Why?
They're locking you in for 5%, 6% if you're really lucky, or 4%. But the real world inflation is much higher than that. If you look at that goldprice.org chart, where you see how gold has performed versus every single major currency, and you can call that a GIC if you will. This is in reverse what currencies are doing versus gold. They're all losing approximately 9 to 10%.
Okay.
So lock in with gold. Lock in the value of your money, your hard-earned money, with physical gold outside of the banking system.
But what would you say to someone, though, who is looking at the gold or silver market and they're saying, but I have to pay these premiums and then I have to pay to store it? Where does it become economically viable to have this when I could just hold a GIC and basically start getting the income right away?
Well, there's an argument definitely to overcome to understand the difference between spot price and the price to buy physical. There should not be a premium in any natural market. If it was a normal market, there should not be a premium. You mean a premium above the cost of fabrication? That's right, or above the spot price. Yes, above the cost even, or above the spot price, the paper price of gold and silver, that futures price. There should not have a premium over for fabrication. It should just be the price. But this is the problem with the paper market. When you have contracts that represent X amount of ounces over the amount of actual physical gold or silver in availability, this is where you have that issue of having too much premium. So with regards to the, what makes this so special about, having physical precious metals in your portfolio, it is your wealth insurance. You're buying physical, yes, you're paying a little bit of premium, but that is the cost to actually get your insurance. Insurance, because it is the only tangible non-financial asset that is a monetary asset that's always liquid and practical to own without ever involving the financial system. And if you're talking about how to sever yourself and your money away from counterparty risks, that is wealth insurance. That is monetary wealth insurance for yourself, for your RSP, for your lira. Countless of people came to me this week, Jeremy, about 3 people. They were fired. They were let go. They just received their packages for their pensions. It was a surprise, but they heard that Guildhall was approaching nurses and doctors and people who have been kicked out and who have been given this pension package, but they're looking to as one person told me, I don't want to participate in that system anymore, Jerry. I don't want to put my money into something where they can use my money and leverage it over and over and then potentially fund something nefarious against me. They're weaponizing my deposits against myself, is what this person said. And I could wholeheartedly agree, and I understood. So this is why we're seeing that people are looking towards physical precious metals, not just for protection, but for the opportunities to actually break free and grow this, because where we're headed, it's going to be fantastic. The gains ahead. Stagflation is here. We're going to get into that shortly. Crescat Capital, Tavi Costa came up with a great chart about stagflation, and you got to be prepared. And the only thing that you can prepare with would be physical precious metals.
Okay, I'm excited. We're going to talk about where the prices are headed. We're going to wait with bated breath for this break. The number 18778 silver, the website guildhallwealth.com. It's the Real Money Show on AM 640. Welcome back to the Real Money Show. The number 18778 silver. The website guildhallwealth.com. You know, Jerry, we just before we were talking about premiums in the market, and look, I think I might see it slightly different. I understand that there's a fabrication cost. You're buying a retail product. Once you own that product, that's it. You're not paying management fees over and over again for it. So there is sort of a one-time upfront cost to buy a physical product like gold and silver, and it is a one-time cost. As far as storage is concerned, you know, you can look at any variety of investments where you don't own anything and they still charge you the storage. So for me personally, if I'm gonna pay for storage, I might as well own the product, right? Why am I paying storage for something I don't actually own? And so that's how I look at it. And I think that the other way to avoid these costs of doing business is cost averaging. You know, looking for dips like what we've seen this week to buy into the market, because you can try to offer the lowest premium possible. You know, you can sharpen your pencil as much as you can, but ultimately the market's going to make that decision for you. And you want to always kind of hold back a little bit to feel like, hey, I've got a position, I'm ready to go. But I'm looking to purchase later, or I'm going to hold back for a rainy day. There's always going to be opportunities. I would say prepare for those opportunities so that you can feel like, hey, I'm able to take advantage of those. And that's what's also going to bring down your cost of doing business. Look, there's going to be a lot of people who are going to buy at the highs. It's just natural. Of course, buy low, sell high. Guess what? It doesn't work like that in the real world. In the real world, most people buy high. Because they get excited about what's going on in the market and they don't want to miss out. And so a lot of people would rather miss out on waiting for the market to take off. And then once there's momentum in the market, jump on. And, you know, who cares if you miss out on a little bit, right? Look at silver. Who cares if you buy it at $50 and you miss out on a $20 gain? Really, who cares? Because as we're about to talk about, I don't know what Tavi Costa said, but I know silver's going to triple digits. So who cares if you buy it at 50?
That's right.
However, you're going to miss out on 80% gains, which is going to be very helpful.
Very helpful.
I wouldn't say I wouldn't say no to 80% gains, but there's a whole swath of people that need to see that 80% first.
That's right.
They need to see those gains first before they get into the market. And you know what that is? That is a lack of research. No offense. You know, there's always different circumstances, timing, personal situations, right? When did they get the funds? Blah, blah, blah. But a lot of it is, did you do your fundamental research? How many ounces of silver is there above ground? How much does it cost to get out of the ground? How much is available right now? What's the general price? Right? What's the ratios? What's the gold silver ratio? What's the Dow gold ratio? How many ounces does it take to buy a house? Did you know that in 1980 you could buy a house in Rosedale, Toronto, premium neighborhood for less than 300 ounces of gold? Today, that $4 or $5 million property is going to be in the thousands of ounces of gold. You're talking kilo bars. You're talking those bars that you see central banks buying. So you're going to need lots of those to buy a property. And then a regular property that needs to be, you're talking over 600 ounces, maybe close to 700 ounces. Is that what it's going to cost in 5 years? I don't think so. I really don't think so. I think as the dollar debases, as these bubbles burst, Exter's pyramid starts to close in on itself, you're going to see the purchasing power of gold and silver. This is my setup, by the way.
Set me up.
I'm setting you up. You're going to see that the purchasing power of those metals goes through the roof. So how can you not be excited?
Exactly, especially when you see dips like this. And just this week, Andrew Hecht, a 20-year veteran in trading precious metals commodities for Bar Chart, he came out with an article not too long ago that talked about every dip in the gold price that the bull market began years ago has been a buying opportunity. And he gets into building the case for gold, and it's going to tie into what Tavi Costa from Cascat Capital was mentioning about the precious metals and commodities versus the traditional stock market. The case for higher gold is compelling, says Andrew Hecht. Firstly, you got the potential of BRICS currency backed by gold. So we have geopolitical and monetary landscapes converging. They all favor higher gold prices today. So he cites the BRICS. Obviously, they're going to be meeting in a couple weeks. The dollar index declined from 115 from the highs down to below where we're at today, around 103. Even regarding central banks and governments, they have been net buyers of gold over the past years, adding to reserves. And when you couple that in with these fundamental factors, with technicals, they all line up in the same bullish direction. And then lastly, obviously, inflation is at the highest level in decades, which makes gold a very attractive investment asset. Yes, investment is that thing that's going to make you money, because when you have inflation, it leads to lower growth. Year over year, profits and earnings have been slashed. Not everyone was winning this earnings season. A lot of the earnings were slashed. A lot of the profits were slashed. So Tavi Costa came out during stagflationary periods. The S&P 500 index, the stock market, tends to be inversely correlated with inflation. We're seeing today, Jeremy, that we're seeing a bottoming in inflation, and everybody is expecting higher inflation. Just look it up. So if that's the case, we have stagflation. And during stagflation, stock markets get hammered. Look what happened in the 70s. Those nifty 50 stocks, they got hammered. And his chart here is clear. Crescat Capital shows that with rising inflation, stocks fall. So if we have a bottoming here and we potentially see a higher rate of inflation, especially if the central banks decide to back off on hiking interest rates, they're going to let inflation go. Higher stagflation. 80% is what you were talking about in the gold market. Yeah, we sure want 80%. Give me 80%. I need 80% right now. But what did gold do during the 70s? Gold went up 838% during that one decade. Silver went up 1,100%. And when we talk about the fundamentals and doing your research, it was the University of South Wales talking about the silver. Those researchers say estimated that by 2027, solar manufacturing will need over 20% of the current annual silver supply. Fast forward into 2050, and it's estimated that solar panel production will consume a whopping 85 to 98% of existing global silver reserves. Silver will become unobtainium. And when that happens, 1,100%? No, that's conservative. I think silver will be going into 5,000%, 10,000%. We'll see. But when you can't get a hold of it, that mania begins. It's just like the toilet paper mania, Jeremy. Isn't that correct?
Well, this is more valuable than that, but I guess it depends on the time. But no, I agree. I think that ultimately gold will break through the 2,100 range. Silver will break through the $30 range. That'll put us into new territories. That's going to start the runoff. I think that could happen this year. If not, we can see it happening easily in 2024. Putting our necks out on the line here on that one. But I think that silver definitely gets into the triple digits. Gold gets above 5,000 over the next several years. And it's going to be very, very exciting. Just do your research, look at the fundamentals, talk to us. We're more than happy to chat with you about the markets. That's it. Jerry, thank you so much for joining us. Thank you to our audience for joining us, all our listeners. We love getting your feedback and your questions. This has been The Real Money Show, the number 18778 Silver, the website, guildhallwealth.com, and we can't wait to speak to you next week.